Hello friends, welcome back to this new video. Would you like to buy stocks at cheaper price or the price at which you have in mind? Yes, it is possible using the cash secured put. That is the way to buy stocks at cheaper price. I'll try to explain how it works as simple as possible. Do watch this video till the end. Let us look at what is the put option. Put option is the contract between a buyer and a seller, wherein the seller receives the premium from the buyer. There can be two outcomes of this contract. One is when the put option goes out of the money, and other one is when the put option goes in the money. When the put option goes out of the money, seller keeps the premium and he need not have to buy an asset. When the put option goes in the money, and when the seller chooses to exercise the option and he is obliged to buy an asset at the strike price at which the contract is being executed. So that means he need to have the equivalent cash ready to buy or take the delivery of the stock. So note that in both the cases, seller keeps the premium that he has received from the buyer when he is ready to take the delivery of the stocks. Now let us look at what is the cash secured put. When you have the equivalent cash available to take the delivery of the particular stock, you can go and sell put option at the strike price at which you want to buy the stock. Usually it is at the money or slightly out of the money. Again, the strike selection can be based on your technical and fundamental analysis. The amount of cash that should be available to take the delivery depends on the lot size and the strike price that you choose. The lot size is different for different stocks. It is different for Reliance, different for Infosys, different for SBI. So again, you will have to calculate and know the amount based on the stock that you choose and the strike that is chosen. In the coming slide, I will explain with an example. Here is the payoff graph for the cash secured put. The y-axis is the profit loss axis. X-axis is the stock price movement axis. Here is a strike at which you have sold a put option of a particular stock and collected this much premium. The collected premium is the maximum profit that you are going to get. When the stock moves above the strike price and expires above the strike price, the strike has become OTM. So you can keep the entire premium that is collected and there is no need of any physical settlement or taking a delivery of the stock. When the stock price moves below the strike price, there is a point called a break-even point at which you can even decide whether to square off the position or you can take the physical delivery of the stock. The break-even point is nothing but the strike price minus the collected premium is the break-even. So once you decide to take the physical delivery of the stock when the strike goes in the money, you need to inform your broker that you have the equivalent money to take the delivery in your account and I am opting for the physical settlement. That is, I am ready to take the delivery. So once the expiry is over, exchange does the settlement and credits one lot equivalent of stocks in your demat account and deducts the equivalent amount of money from the demat account. So that is a physical settlement. So this is the lowest risk strategy because you have the cash ready to take the delivery of the stock when the sold put option goes in the money. So it's important to choose the right stock which you want to keep it for the longer term and also choose the right strike at which you want to take the delivery. Let us take Reliance as an example, which is trading at the price of 2550. So you are comfortable to acquire the Reliance at the price of 2500. So you go and sell a put option of Reliance at this strike price, that's 2500, and collect the premium of 30 rupees. The total collected premium is lot size into the premium. So the lot size for Reliance is 250 quantity. So the total collected premium becomes 7500. The cash required to receive the shares in case of physical settlement is lot size. The Reliance is 250 into the strike at which you sold the put option, irrespective of where the Reliance is trading. So that becomes 6,25,000. Now, when Reliance expires at 2,500 or above 2,500, so the sold put option becomes out of the money, and you can keep the entire collected premium, that is 7,500 rupees. When Reliance expires less than 2,500, so that means the put option, the sold put option becomes in the money. Okay, and let us assume that you will opt for the physical settlement. That means you have to inform that your broker that I am ready to take the delivery and I have the cash. So at that time what will happen is 6,25,000 amount will be deducted from your demat account, and 250 quantity of Reliance share, that is one lot of equivalent of Reliance share, will be credited to your demat account. And the premium, what will happen, you still keep the premium of 7,500. Effectively the acquisition price of Reliance has become 2,500 minus the premium collected, that is 30 rupees. So the acquisition cost is 2,470 rupees. This is how you can acquire the Reliance at the price at which you have decided and at the cheaper price. So you selected the strike price of 2,500, your acquisition cost has become 2,470 rupees. Here are the advantages of the cash secured put. The premium collected from the put option selling is a guaranteed return, and the strategy is used for acquiring the stocks at the cheaper price. Since the position you are taking is against the cash that is available, selling a put option, naked put option, is totally risk free. It does not require active monitoring because you know you want to acquire the stock at a particular price against which the position is taken. You need not have to monitor all the time, and it is possible to generate higher returns by doing adjustments and rollovers. And also you can do some tailored cash secured puts such as put ratio spreads to generate incomes. Requirements and pitfalls of cash secured put. Of course, you need to have a capital somewhere between 5 to 10 lakhs to acquire the stock, and you need to select the right stocks based on the technical and fundamental view. And also you need to have a liquidity in the stock options. Here is the summary of the cash secured put. It is one of the lowest risk option selling strategy. It is a guaranteed return strategy. The return is equal to the collected premium. One of the best strategy for people with capital of around 5 to 10 lakhs and has less time to trade. It is best suited for the part-time traders, investors and professionals who do not have time to trade. Friends, this is one of my favorite way to acquire stocks at the price which I am looking for. I hope you learned something out of this video. Do share this video to your friends who are interested, and do subscribe to this channel. In my next video, I will be covering how to generate monthly income using the combination of covered call and the cash secured put. Stay tuned. Thank you for watching. See you soon.